Thank you, Mo, and hi, everyone. It is so wonderful to be here to talk to you about the immense opportunities that we believe are in the fixed income markets today. But before I jump into the opportunities in the fixed income markets and where and how you should be investing in bonds, we'll spend just a little bit of time actually talking about what is the economy bringing us right now. What do we think about the US economy? There's obviously so many interesting things going on. You hear about inflation. Obviously, there's uncertainty around elections. Every single day there's some new data point, which is either, making you very excited about the economy or making you question what is happening with prices or what's happening with mortgage rates or the housing market. So we'll talk about all of that a little bit. And then we'll move to, the slide that I have here shows number two as the Fed, which is, of course, the central bank of the United States. And as many of you know, the Fed has been raising rates. We are sitting at 5.375%, which is the highest that we've seen interest rates be since the mid 80s. And over the last 12 months, so exactly in July 2023 was the last time that the Fed raised interest rates to this 5.375%. So we'll talk a little bit about what our expectations on interest rates are. So what is the Fed going to do for the remainder of this year, but also looking forward? What is the Fed going to do in 2025 as well? And all of these, the picture of the economy, whether or not we're slowing down or whether or not prices are going up and down, and the picture on interest rates from the Fed, all of that will really drive our thinking about bonds. It'll drive our thinking about fixed income. So the one and the two actually lead us to where in fixed income we see the most amount of opportunities and why you should be thinking very strongly about fixed income and the profound opportunities that they present in your portfolio to clip some coupon, to earn some income. We're seeing levels that we haven't seen in multiple decades to have fixed income as a really valuable source of income in your portfolio. So with that, let's get started talking about the economy just a little bit. So on the left-hand side of the slide here in front of you, you can see in these very pretty orange and yellow charts, bar charts, you can see a quick look at how the economy has grown. So this is the picture of the quarterly US GDP. And as you can see, there has been a moderation in growth. So, in the third quarter of Q3, so about a year ago, we were growing at close to 5%. Now, the U.S. economy, thankfully for us, those who live here, is a very advanced, a very mature economy. So it's really not possible for an economy at this state of maturity to grow at levels that are close to 5%. That's really related to how we get the growth of any country is really related to how many people there are, so the demographics of a country and the productivity of a country, so how hard they work. So when you add those two together, the demographics as well as the productivity, you get the output, you get what growth of an economy is going to look like. And for several reasons, if you look historically, we've sort of always been around that 1.7 to 1.9%. That's known as sort of the potential growth of the US. And what's really lovely in 2023 is you can see that we grew well above potential. What we're seeing in 2024 is that growth has still remained very, very strong. That's the main thing that you should take away from these yellow bars in on the left-hand side, is that while it is softer than the 4.9 and the 3.4 figures that we saw in 2023, these are still very strong, very positive growth numbers. They're still at very healthy levels. And, like I said earlier, we can't really expect to be at those above potential growth. It is very natural for an economy that is at this stage of maturation, that is at this part of the cycle, which means that, we had a recession, we came out of the recession. It's very natural for us to expect a little bit of softening. What you're not seeing, though, in these charts, which is also important to think about, is any hint of recession. And just like it's important to talk about what we are seeing, it's also important to talk about what we're not seeing. And again, what we're not seeing and what we're not expecting to see, if we look at, sort of Q3 2024, that E stands for estimated. That's where our estimated expectations of growth are. Forward looking estimates can, often may not come to pass, but that's the best estimates that we have. You can see that these numbers are still very positive. They are nowhere near zero. So often, we get asked by colleagues and other clients, is the US economy anywhere close to a recession? Can we expect negative growth? And as of right now, it's important to really look at these numbers and acknowledge that while growth is slowing down, it remains positive. We're nowhere near recessionary levels. And even though many people, many investors, and certainly, I myself at one point had been a little bit nervous last year that perhaps we'll begin to see a little bit of softening even towards a recession because interest rates were so high. Actually, that didn't come to pass, and that's really good news. So now if we look at the right-hand side of the screen, what we'll also find is in addition to this really great growth picture, what we're also beginning to see is a really good labor market picture. So what we're seeing here is the unemployment rate. And that is obviously a look at how many people in the economy are not employed at the moment as a percentage of total number of people. And you can see that obviously in March, at the depth of COVID, the unemployment rate, of course, shot up pretty significantly. And that makes sense given the impact that COVID had on the economy and the shutdown. And that's obviously a very anomalous period, right? We don't want to necessarily compare our life right now to that very anomalous period, which is why we look at the 20-year average. And when you look at the unemployment rate over the last 20 years, you can see that that was about 5.8%. And currently, and by the way, this is a little bit stale as of the data right now. Unemployment rate is about 4.1%, but the picture still is the same, that we are significantly below that 20-year average, and we're obviously nowhere near the levels that we had seen during the pandemic. So the picture that you're supposed to get from this page is a healthy economy and also a very strong labor market. So many people around the country feel like they can get a job if they're looking for a job. More and more, we're looking and finding that there are many more jobs available than people looking for jobs. And even though there is a little bit of unemployment at 4.1%, that still is very commensurate with a healthy economy. If I look at sort of what other sentiments and other indicators are showing, obviously many of us have felt and read in newspapers that mortgage rates have been going up and are at all-time highs. But the good news is this, that because in the US we're privileged enough to have this 30-year fixed rate concept, which by the way, our neighbors up in North in Canada, they don't have, and many of our colleagues across the world and friends across the world don't have that concept of a fixed 30-year mortgage rate. When mortgage rates in the US move up, most people that have that fixed 30-year mortgage don't actually feel the effect of higher mortgage rates because they bought their house and were lucky enough that they actually locked in their mortgage. So what this chart is supposed to show you in red on the top left-hand side is that the effective mortgage rate, so that's actually if you look across the economy, what people are paying on mortgages still remains fairly low. It remains significantly lower than the approximately 7.5% mortgage rates that are available if you were to take out a new mortgage today. So, yes, of course, if you were to take out a new mortgage today, you would have to pay the market rate, but many in the economy are already locked into mortgages and they were able to lock in during either the pandemic period or even before that when rates were at much more favorable levels. So part of why I bring this up is to show you that consumers, you and I that are spending money and are enabling the economy to grow as a result of what we're spending. Consumers, you and I, make up about 70% of the economy in the US. So how we feel about our spending ability is really important to the growth of the US. And you can see here, because mortgage rates are still effectively very low for the economy. If you have a home and you're locked in, you're not getting impacted by the higher rates as much, which is very different from what the dynamic would have been even about 2 decades ago. And you can see some of those numbers in this chart where, in 2000, the effective mortgage rate was a lot higher. And then, obviously, we looked at households, but even corporates. If you think about corporations, so not household, but companies, are also not actually feeling that massive amount of higher rates either, because many of them were able to take advantage of lower rates and term out their debt. So they're not paying, so even corporations are not paying those higher interest rates, and households are not. And as a result of that, mostly, if you look at one of the ways in which we look at sentiment, that's the University of Michigan Sentiment Index that we have here, that's dropped a little bit off these numbers, but still remain very high. So people still feel very good about their ability to get a job, their ability to actually not pay higher interest rates, especially when it comes to mortgages, and also the impact of inflation actually moving lower, which brings me to my next slide. And look, you can't have any conversation or you can't open the newspaper or turn on the TV really without being faced with some news on inflation, right? So obviously we had a very high inflation rate that was sort of that we all felt very much in our day to day back in 2022, perhaps even in 2023. And this chart actually shows what that inflation rate looked like. So if you think back, if we can even think that far back, if you think back to the pre-pandemic regime, inflation was kind of at 2% for a very long time. And if I took this chart back even further back, if I thought about where inflation was all the way from 2000s to 2020, inflation was kind of more or less at 2% for a very long period of time. And then, of course, after the pandemic, you had this period of rapidly rising inflation for many, many reasons. Obviously, supply chains and was a big driver of that. And obviously, many of us were home and we were ordering things on Amazon all the time because we couldn't go out. And as a result of that shift from many of us from going out to spending money sitting at home was blocking the supply chains even further. The demand for goods was just not able to keep up with the supply, and then there were idiosyncratic other reasons for this chart to pick up the way it did. Now, what the good news is today that I want to share with you is we're already beginning to see a rapid deceleration on this path of inflation. Now, I will say here that it might feel when you go and spend, if you sort of go and spend, whatever, $6, $7 for a smoothie or a lunch or a salad, it might feel like that number is still quite high, right? So you might be spending a lot more on your meals than you have in the past. And I know that's really difficult and unfortunate. But what I want to point out to you is that that number isn't continuing to move higher. That's inflation. Inflation is the rate of change. So your level might have, it might used to be 5 before, now you're at 7 to get a smoothie, but it's not moving up to 8 or 9. And I think that hopefully is a little bit of a good news. And certainly consumers are beginning to see that. They're beginning to feel that you're not continuing to feel that pressure of the pinch of higher prices. And even though we've already seen this red bar move lower, you can see that, since the middle of 2023, we've seen a rapid deceleration of inflation. We continue to believe that there is, if you look at the green line, assuming 0.2 is where sort of inflation comes in for the next couple of months, you can see us steadily moving our way back to that 2%. It'll take a lot of disinflation for us to get back to below 2%, that pink line. That's assuming that we only grow at about 0.1% on a monthly basis. I don't know if that's necessarily going to be an outcome. But I think even if we look at this green line as a nice assumption of where inflation can be, you can see that prices will come back to near that 2% level, which I think is really, really important as we think about the role of bonds and the role of fixed income in your portfolio. So the combination, we talked about the economy, we talked about the inflation a little bit, which brings us to the Fed. Now, as we know, the Federal Reserve is the central bank of the United States. The Congress gives them a dual mandate. The Congress tells them that the two things that you have to do are you have to make sure that inflation remains steady, so prices remain stable, price stability, and that is defined by about 2% in terms of what the inflation target for the Fed is, and that they have full employment. And what full employment means is that when people are looking for jobs, they're able to find jobs, and there might be a little bit of, right now about 4% is the unemployment rate. That's fine, but that should be a steady, stable rate. That there should not be too much unemployment in the economy. So price stability on one hand, prices should not go up too much, prices should be around that 2% level, and there shouldn't be too much unemployment in the economy as well. So as of right now, keeping these two mandates in mind of price stability and full employment, that is really what drives the Fed to make their decision on policy. And I will say, over the last sort of 2 or 3 years, the reason that or 2 years, the reason we've begun to see interest rates, or we've seen interest rates moving higher in 2022 and 2023, is because inflation, as we saw in the chart previous, was much above that 2% level. And the Fed, one of the things that they do when inflation is above their tolerance is they raise interest rates, and we saw them doing just that. Now, the good news is, as we showed you in the chart before, that inflation is moving lower. And because inflation is moving lower, and at the same time, unemployment rate is very stable, steady at approximately 4%, a little bit higher than that, our belief is that the Fed will start cutting rates. So our expectation is that they'll start their rate cutting cycle in September of this year. They have 3 more meetings. So the Fed meets about 8 times a year. They've had a couple of meetings already. They actually are going to meet in July of this month. We don't expect them to cut rates in July. They're going to meet in September, and then they're going to meet again in November and then December. So there are 4 meetings left this year, of which the July meeting, they're not going to touch rates. And then in September, November, and December, we think they're going to give us 2 rate cuts in the remainder of this year. So the markets, pretty much, that's what the chart on the left hand side shows, that the market's actually pricing in for the Fed to give us a rate cut, not just this year, but also in 2025. So this chart only goes out till 2024, where you can see interest rates coming lower. And then in 2025, the market is expecting rates to go down even further. And the reason that the Fed will continue to move rates lower is because inflation is going to continue to come back down to their target. Now, this is really, really important. As the Fed moves interest rates lower, which is again our anticipation of what they're going to do, that is going to make investments in bonds attractive. And by the way, if you were already invested in bonds, you were already beginning to get some very attractive interest income by owning bonds, and we think that that's going to continue to be the case. And this is actually one of my favorite slides in this slide deck, and I could literally spend the entirety of the 30 minutes just focused on this slide. A lot of pretty colors, but what I want you to really focus on is the number of colors that make up each bar on this chart. So if you looked at that period, sort of from 2010 all the way till 2023, you can see that you weren't really getting a lot of yield. First of all, that income, the yield, which is what we call it, levels were so low because the Fed, the central bank, had kept rates at zero. We were coming out of that great financial crisis, and rates were very, very low. And there was only, what this chart is showing you is the fixed income or bonds that gave you more than 4% income. Right, so you were only about 20%, and even in some years even lower than that. Such few percentage of the fixed income market even earned you 4%, right? So first of all, you weren't getting a lot of yield. Now, looking back to 2001, 2002, a very different era altogether, but you could get that 4% very, very easily. Fast forward to 2011, 12, 13, 14, all the way till 2022, you weren't really able to harness that 4% yield very easily. And When you did, so again, looking at the green and the gray bars here, when you were able to get that 4%, it was in more volatile parts of the market, riskier parts of the market. So the green here represents the high yield market, and then the gray here represents emerging markets. So looking at countries that are, still sort of not at developed markets rates, they're obviously a little bit riskier in terms of getting your money back. That's why you earn more yield, because you take a little bit more risk when you invest in emerging markets. And that's how your portfolio would have to be positioned to earn even 4%. Now, fast forward to 2024, which is where we are now. You can get 4%. You can basically build a portfolio of bonds earning you 4% very easily. You can get that in treasuries, you can get that in municipals, you can get that in investment grade credit, high yield credit, agency mortgages, you can get that in securitized assets, obviously emerging markets as well, European fixed income. So there's a plethora of ways in which you can build yourself a portfolio that earns you 5% or even 6% and still be very diversified, right? And I think that is the most important point here. Number one, we are at levels of yields that we haven't seen since the financial crisis. So that's number one. So that this repricing higher, with of course the Fed moving interest rates to this level and keeping them there, is providing this incredible opportunity to own bonds in your portfolio, earn income in your portfolio. But more so than that, not just the level of yields, but the type of bonds that you can hold and earn that yield compared to a decade ago. And I think that is the point that I really want to leave with you today, that a decade ago, if you wanted to earn 4 or 5%, you'd have to have a much riskier bond portfolio. And look, if you wanted risk, you could just be in equity markets. You didn't necessarily need to be in the fixed income markets. So over the last decade, many investors didn't actually want to be in fixed income markets because they felt that they weren't being compensated accurately for the amount of risk they had to take. Because again, you were owning emerging markets and you were owning high yield. And as a result of that, I think many investors were moving to equity markets or private markets. And today, there are these amazing levels of yields where you can make a 6% portfolio for yourself very simply, and it can be very, very diversified. Now, moving into sort of what, we talked a little bit about why fixed income, and we talked a little bit about the yield that's available to you in the fixed income markets. But where you own fixed income also matters, right? So we have a very simple chart here, which looks at different parts of the yield curve, right? So, the Treasury will issue you bonds that mature maybe 1 year from now, 2 years from now, 10 years from now, 20 years from now. And depending on your risk appetite, depending on when you want to get those coupon payments or those interest payments, you can certainly decide what that right tenor of bonds is for you. What's actually very interesting right now is that the way in which the Fed has raised rates and the way in which the market has responded to the Fed raising rates has created this inverted yield curve. So right now in front of us, we have this normal shaped yield curve where if you borrow money for 2 years, you sort of earn a certain amount of yield. 10 years, you earn a little bit higher than that, and 30 years, you earn even higher than that. Let's think about our own lives, right? If we lent our friend money and they were going to give it back to us within the end of the day or the end of the week, we would probably, well, it's a friend, so we probably wouldn't charge them interest anyway. But if we were to charge them interest, we would probably charge them a lower amount of interest if we trusted them and they were like, hey, I'm going to get this back to you within the end of the week. And we're like, yeah, okay, that's just 2% interest rate. But if they were like, look, we're leaving the country, we're going to come back in 15 years, and that's when we're going to return you your money, you would probably want to be compensated a little bit higher for that, right? So even if we did that for our own personal money, if someone said we'll return this money to you in 10 years and God knows what I'm going to do with my life in the next 10 years, it'd probably be like, maybe not 2%. Maybe I want to be compensated a little bit more for that additional time and what might happen to you in that additional time. Similarly, in the markets, usually when you look at that interest rate, when you look at that yield curve, the interest rate curve, it slopes higher. So if there is a bond that's maturing in 5 years, that's probably going to earn a little bit more income than a bond that's maturing in 2 years. And then a bond that matures in 10 years will be even higher income than one in 2 years. And all of that is because you are locking up, you as the lender are locking up your loan for a little bit longer period of time, and there's more risk associated with that. That is not the case right now. That is the usual shape of the yield curve. What's happened right now, because of the Fed being very much in play and having kept rates at 5.375% for the last approximately 12 months, actually almost exactly 12 months, you are earning more income if you are in the very front end. So if you're in the 1 year, the 2 year, 3 year, 4 year, 5 year part of the curve, than you would if you're in the 10 year, 20 year, 15 year part of the curve. So what we're telling investors to do, and we write that on the top of this page, is if you're owning treasuries or investment grade credit or agency mortgages or high yield or emerging market, when we go back, if you're owning any of the bonds that are depicted in this beautiful chart here, we think you don't need to own a lot of interest rate sensitivity. You can have your interest rate sensitivity in the very front end. Maybe in the belly, you maybe want to go out 5 years in terms of the maturity that you want to own, and that will give you more yield than you would if you went out much longer than that. So you won't take a lot of volatility in the 2 to 3 to 4 year part of the curve, but you would actually get higher coupon in some cases. So where you own fixed income is also really important, in addition to, of course, having higher yields and a pretty diversified source of fixed income. I'll also spend a little bit of time just talking about something that's really meaningful right now, and that is the amount of investments that are sitting in cash. So if you were just in a money market mutual fund, you can very easily earn, about 5%. So many investors have definitely allocated to cash. Right now, there's about 6.2 trillion sitting in cash right now. As you see in this chart, the money market funds are actually in green, and you can see a tremendous amount of inflows, especially in 2023 and certainly in 2024 as well. You can see investors continuing to drive, both in Q1 as well as in Q2. You can see investors continuing to drive flows into money market mutual funds. And as a result of that, there is a lot of money sitting in the sidelines. And I want to also say that, as opposed to 2020, which was another period of time where you saw a lot of money moving to cash, but you were not earning anything in that period. In 2020, you were moving to cash but earning zero. In 2023, I have to say that moving to cash, earning you over 5%, can seem very attractive. So it can be thought of as an asset allocation decision. But what I really want you to sort of take away, perhaps, is that when the Fed starts cutting interest rates, which we think is going to be very soon, actually, right? Like later this year, as I laid out, in September, they're beginning to cut rates. We expect them to begin to cut rates. You're not actually going to earn that entire full 5% or 5.375% if the Fed already cuts rates between now and, end of first quarter or first half of 2025. So you're not going to get that full cash yield. And we actually think now is a perfect time to move out of cash. So if you were sitting in money market mutual funds, that was amazing, especially in 2022, you outperformed the markets. But in 2023 and 2024, fixed income and equities actually did give you returns. And even this year, we think that, especially with the Fed poised to cut rates, we think you should be clipping those coupons in that very, very attractively priced, income generating, intermediate duration belly of the curve. So really sort of thinking about stepping out of cash and really taking advantage of the incredible yields that are available to you in fixed income. And you can actually see that, just in 2023 as well as in 2024, we've already begun to see Treasury ETF inflows. You can see that on the top right-hand side, both intermediate as well as long and short-term investors moving to Treasuries, moving to other parts of the market as well, IG, and then active is continuing to take in a lot of money as a percentage of all flows. So investors are looking for dispersion. They're looking to, they're certainly going to index products as well, but active is, as compared to the previous periods in 19, 20, 21, 22, you can certainly see 2023 and 2024 being driven by active. So that means that there are opportunities for active managers to take advantage of these incredible opportunities in the market, and investors are recognizing that. So I was told about 30 to 35 minutes, and I think I'm right around at 33 minutes. So with that, I'd love to turn it back over to Mo, and I'm happy to take whatever questions you all have. Mo, if you're speaking, you're on mute, so I don't hear you.
Thank you for letting me know that. I'm known as mute, not Mo, because I'm always on mute. So are you ready for your questions?
Yeah, sure, absolutely.
All right, so one takeaway that I got from this amazing webinar is that fixed income is a rock star, pun intended. Anyways, I'm just being goofy. All right, the first question we have is, we've seen a few economic indicators come in a lower over the past couple of months. Manufacturing has cooled, unemployment has crept up. Are you concerned at all about this potential softness?
Yeah, it's a great question, and to your point, there have been a few areas where we've seen a little bit of softening. I'll go back to a chart that I used right at the beginning, which was this one on the left hand side. So manufacturing has come in a little bit cooler. I think the one thing that many of my clients that I meet as I'm traveling around the country that ask me about is really this pickup in unemployment rate. Unemployment rate was as low as 3.4%, and now it's picked up to a little bit over 4%. So that has caught people's mind for sure. And also just this picture of the orange bar to yellow bar, that moving lower from sort of the high threes to fours to below 2% has caught people's eye. So what I'd point to you over here is level versus change. So even though there has been some softening, the softening comes from very, very strong levels. So the economy, especially coming into the second half of the year, was growing very, very strongly. It was really coming at elevated paces because so many companies were feeling very confident about where they wanted to spend money. There was so much spending in AI. Consumers were feeling very strong about their job potential. Wages were rising. They were earning income. Inflation was coming down, so your real income felt pretty solid. So people did feel so the levels were very high. So from those levels, we're softening a little bit. So the change is not so stark. The levels are lower. So I think going forward, we should get used to a world where things are much more moderate, where we can begin to see growth instead of coming in at 3.5%, 4%, growth coming in more closer to 1.5 or 1.6%. That is fine. That is healthy. As long as when we would begin to get concerned is, if unemployment rate suddenly picked up to 4.5%. Actually, at this stage, given how long ago the recession was, given how mature the economy is, everything is a cycle. We're at one end of the cycle. At this point in the cycle, having a below 4% unemployment rate was the anomaly. It wasn't the fact that it's moving up. So again, moving up gently, gradually in terms of unemployment rate, and moving down gently, gradually in terms of GDP growth is okay. We're obviously going to be very cautious about something very stark. So if we suddenly see unemployment rate over the next 2 months, moving from 4.1% to 4.5%, for sure, that'll be something that we'll be concerned about. If we suddenly see a big shock to consumers that were feeling very good about spending, remember we saw this slide where consumer sentiment has been at pretty solid levels on the right hand side. If that suddenly plummets lower, we'll certainly take that'll certainly be a signal to us of something is going on. But for now, it's a moderation from very, very high levels. The very, very high levels were unsustainable. This is a normalization, not something to be scared of.
Thank you for that. What about, Randy asked, what's the outlook for fixed income over the next 3 to 5 years?
Yeah, so over the next 3 to 5 years, the great thing about where yields are versus where they have been historically, and again, bringing you back to this chart, is that the starting point is very, very high, right? We already got Fed funds rate back to that 5.375 level, which last used to be the case in the 1980s. So as I think about the next 3 to 5 years, what can we expect? Can we expect fixed income to get back to that 2010 to 2020 period where we were at zero rates? No, we don't think so. We think that that was a period of time where, because of many extraneous circumstances, because of inflation being so tame at sub 2%, because we were coming out of this really pernicious recession. The 2008 recession was truly, like, it was really terrible, and it was so hard to get the labor market to normalize after the recession. You had what we call the jobless recovery. Because of that, the Fed had to keep rates low for a very, very long period of time. That is not the normal economy. Even though for many of us, maybe that felt normal, that is not normal. So the new normal, the new reality is that even though we may not have these yields of 5.375 forever, we will probably not go back to zero either. We will probably see Fed funds rate, so that's the rate that's set by the central bank, remain at, maybe 3.5%, maybe 3%, not 0%. Which is why, you'll probably not necessarily have today's fixed income yields, which is why we feel that there's a lot of urgency to own fixed income. That's why we're presenting on fixed income, to make sure that our listeners are taking advantage of these opportunities before the Fed starts cutting rates. Having said that, are they going to go back to zero? No. So you can still, maybe in a year's time or 2 years' time, you can probably still get a 3% fixed income outcome. Not as attractive as a 5% fixed income outcome, but certainly not as dismal as a 0% or a 30 basis point fixed income outcome either. So I think the picture ahead looks a little bit different from the previous decade, but at the same time, right now, the levels that you're getting in fixed income are super, super attractive. And frankly, we've already, there was a period of time just about 4 or 5 months ago where 5-year treasuries were about 80 basis points higher, so about a percentage point higher than they are now. And they've already come down from the most attractive levels. And our view right now is that they're not going back to those levels. The inflation has come down meaningfully, and there's no reason for us to believe that the Fed is going to raise rates again. And there was that little fear in October of last year or September of last year. So we've already seen some of those amazing levels come back down to earth, but we are still at some very strong fixed income yielding levels. But the one thing I would reiterate is we're not getting back to that zero interest rates anytime soon.
Excellent, thank you. What about Q1 approve the path of inflation is not a downward trend? When we saw a few CPI reports surprise to the upside, can you walk through some of the key components that you'll be watching?
Yeah, so one of the things that drive inflation, so actually, if I take a step even back before that, when we all think about where we spend most of our take-home pay, right? Where is much of our wallet going? Where do you spend the most of your take-home pay? Probably, if you're like everyone else, you're spending a lot of that on your living. So whether you rent or whether you own a home, you're taking a lot of your take-home income, and a bunch of that is going towards either your rent or your mortgage. The second big chunk of your take-home pay, your disposable income, if you will, goes towards your car payments or your credit card payments. Historically, this is what tends to happen for most consumers. Maybe this is the case for you, maybe it's not, but generally it's the shelter or rent or your housing is the biggest chunk of payments for any consumer. Similarly, when we look at CPI, which is the Consumer Price Index, the biggest component of that is also the cost of rent or the cost of what is called owner's equivalent rent, which is another way of measuring housing. So, as we think about the potential path forward for inflation, whether or not we get the pink line, the green line, or the purple line, that will very much depend on where housing prices go. And frankly, housing prices were very, very pernicious, very, very sticky, especially in 2022, 2023, because there has been a housing shortage, right? Unfortunately, one of the effects of higher mortgage rates, as well as many people being locked into their mortgages and paying that effective mortgage rate that's a lot lower than the current mortgage rate, is that people didn't want to sell their homes. They didn't want, even if you were older and if you were looking to downgrade into a smaller home, or you might have got a better job opportunity in another city, a consideration was your mortgage. If you wanted to move homes, you'd have to take out a whole new mortgage because you can't transfer your mortgage. And as a result of that, the supply of homes in the market was actually and still continues to be quite low. And as a result of that, actually, as more and more people were moving away from cities into suburbs, etc., there was just a shortage of housing, which resulted in housing prices continuing to stay very elevated, even though interest rates and mortgage rates were going up. That resulted in shelter inflation, which is that's the technical term for it. Basically, think of it as the price of housing and CPI. That remained very, very sticky. Now, the good news is, just as of this month, we saw a first crack through in that in the measured CPI housing prices. And our expectation is that continues to move lower. So, to the extent that this is not a one off, but an actual trend for housing prices and rental prices to continue to move lower, that is certainly something that we're going to watch. Another big driver of inflation, especially in the 2021-2022 period, was what was goods inflation. Now, inflation is broken down. And by the way, guys, I love talking about inflation. It's sort of what I grew up doing. So I can go on and on about this more. You will have to cut me off. But one last point I will make on this is a big driver of inflation in the 2022, 2021 was supply chains, right? As I touched on this a little bit before, but goods inflation went up a lot. And goods are things you can touch and hold and feel, and services are things that you experience. And goods inflation went up as we all sat at home and ordered things on Amazon. Services inflation did not, because we were home and couldn't go for the Taylor Swift concerts. Now, as the economy normalized, not just now, but all through 2023 and all through 2024, you did have that revenge spending, if you will, where we all went to concerts, went out and traveled again, and enjoyed the outdoors and things like that, and didn't do as much of sitting at home and ordering online. Goods inflation and the supply chain issues that had surrounded that started easing meaningfully. Now, to the extent that that is something that we have to continue to be watchful for, goods inflation is actually quite low right now. It's actually 0%. That's again one other thing that we're watching. And while we're on this topic, I will say, if you're reading the newspaper right now, obviously you have read a little bit around expectations of tariffs and what that might do for inflation. And look, that's something we're watching as well. If there is concerns around any kind of future tariffs on goods that are imported into this country, be that from China, be that from other partners of ours, that can lead to a one-time impact on inflation to the extent that is passed down by corporations to end users. Again, something that we're watching. So two things to end. We're certainly watching housing prices, we're watching goods inflation, and certainly tariffs is a portion of that, which we will keep an eye on for the quarters and months ahead.
I'm kind of tired of spending $5 on a pepper. So
yeah, no, I hear you.
So Al asks, considering the apparent slowing down of inflation, is now the time to invest in bonds?
Yes, absolutely. As we were saying earlier, this is very much the time to be invested in bonds. Where you own bonds is very important. We think the part of bonds that you want to own is very much in what we call the belly of the curve, owning 5 years, the 5 year part of the treasury curve. You can use, you can obviously buy. We like I bonds, which give you sort of a maturity at a certain period of time. You can own individual bonds, you can buy a mutual fund, you can buy an ETF. There are many ways to sort of get that exposure. We certainly think with inflation coming down, as well as the Fed being poised to cut rates, we certainly think that this is the time. And we hope that you'll take some of the cash that you've been sitting on or others have been sitting on and allocate to the bond markets and earn some of that incredible income that's available to you.
And another fixed income is back, as one of your slides said. And it's not just in the United States. Are there any international pockets you see opportunities in?
Yeah, absolutely. And to your point, many central banks in the last 5 years had been moving their interest rates higher. So those were central banks both in the developed markets as well as the emerging markets. What has been interesting, especially now, is that emerging markets have actually been able to fight inflation a lot more quickly and a lot more easily than some of the developed markets. So, as a result of that, many emerging markets have already been able to start on their interest rate cutting path. So outside of the US, outside of treasuries, especially in the 5 to 7 year part of the curve, if you're looking for other areas where you can potentially earn some income, we think emerging markets can actually be a really good source of income in your portfolio. So I will caveat that by saying that when you're owning emerging markets as a part of your fixed income portfolio, you are going to be subject to a little bit more volatility, but also because you are subject to more volatility, you're also garnering and harnessing a slightly higher income and a slightly higher yield. So it's very important, while we are very constructive of emerging market debts right now on a hard currency basis, it's important to recognize that there is more volatility associated with that. So more income, more yield, more volatility, but still we think to the extent that we remain very cautious. Sorry, we remain very focused on growth in the US. And as a result of growth in the US remaining very strong, we expect growth globally to remain very strong. So we're pretty, as of now, bullish emerging markets. In addition to the growth drivers, there's also the fact that emerging market central banks have already begun to cut rates and will continue to cut rates. And as we know, when central banks cut rates, that's actually very good for the bondholders of that country, much like we're talking about in the US. So certainly emerging markets is an area that you can explore, but be cautious about slightly more volatility in the emerging markets, and certainly focusing more on the emerging markets that are beginning to cut rates and can continue to cut rates than others that may not be in the cutting cycle. So obviously there are many countries. Emerging market is not one region. There are some countries that are actually moving rates higher and some that are cutting rates. So focusing more on the ones that are cutting rates.
Well, thank you for that. What about, here's a sector question. This is from Brian. Given the low current default rate and higher yields offered by junk bonds, which sectors would you recommend?
Yeah, so to your point, we actually have a slide on this. There are certainly, the expectation of, my screen just froze, never mind. The default rates are very low. We're looking at high yield. If we look at spreads across the curve, they are at fairly fully valued levels, to be honest. And I think thinking about high yield is important, but we would recommend investors actually think about an active management approach when it comes to high yield, because there's certainly areas of the high yield market that are the most tight in terms of spread. And then there are some areas, telecom comes to mind, where the spreads certainly are a lot wider. They're not at their, the richest percentile. They're actually more middle of the range. So what we're telling investors to do is look for active management, perhaps go towards the type of active management in high yield where some of the more riskier names are defaulted, or more likely to default, are screened out of the benchmark. So instead of going for that broad benchmark, think about a strategy which is able to screen out some of the names, not sectors, but names specifically, that are more likely than others to get downgraded in the months and quarters ahead. I will also say that, especially given that we're about to enter into election season, there's going to be a lot more question, or we are in election season, there's going to be a lot more that we're going to find out on corporate tax policy, right? So that's something that's obviously going to come up again and again, depending on the candidate, depending on their tax policy, depending on who wins, or what kind of, if there's a Democratic sweep versus a Republican sweep, or a divided House in Congress. And I think that depending on the outcomes, the tax policies will have the most amount of impact on different sectors of not just high yield, but IG as well. So again, that's another reason to think about active management, to think through, okay, so if corporate taxes go here, how am I better off in, sort of energy versus telecom versus tech versus financial? So sort of having someone that can do that decision making for you. And I think especially in years like this, where a lot of things such as tax policy is in question, can be prime for active management.
Fantastic. So why don't we talk about corporate credit? So far this year, we've seen an investor preference for investment grade over high yield, at least by ETF flows.
Seen more of a gravitation towards that. I think as we look ahead, to the extent that growth still remains strong, which is our base case, we think that both investment grade as well as high yield can continue to do well, right? So year till date, both IG and high yield bonds have done well. Obviously, high yield has had a slightly better outperformance because of the shorter duration and because the general risk on nature that has taken place in the market so far. Obviously there can be some pullbacks in the market, especially as we go into August, September. But I think if we, from now till the end of the year, can spreads continue to be here or a little bit tighter than here? I think so. Going forward, I think there's room in your portfolio for both IG as well as high yield bonds, keeping in mind that if you're looking at the index level, IG bonds on an index level tend to have a slightly higher duration. So if you're looking at investment grade, we would tell you to look at investment grade very much in that 5-year part of the curve. We think that the long end investment grade can come under some further steepening pressure. So yields in the long end can go up further. When you're looking at high yield, again, I answered this question just now. When you're looking at high yield, obviously there is a consideration of corporate tax policy as well as default rates. Again, default rates have remained very, very high, as many corporations have termed out their debt, and much of those debts, default rates can't pick up as much next year because there are no bonds coming due. There have been, I think I have a slide on this, there have been a lot of the maturity wall. If you look at in April 23 versus 24, look at that maturity wall having the number of debt maturing from 23 to 24. There, when there isn't as much debt to mature, it's hard to get those defaults, right? You only see that picking up in 2026 a little bit, and truly in 2027. So we're not too worried about default rates picking up pretty meaningfully. So high yield, we think, still makes a huge amount of sense as a source of income in your portfolio. But again, this is where we're telling investors to be a little bit more focused on looking at that active management within the high yield space, because while yields are attractive, spreads are very, very tight. So look at active management, look at we think looking at screened high yield, where we use some systematic screens to take out names that are more likely to get downgraded, which we think that makes a little bit of sense.
We're almost at time. Are you ready for just one more question?
Sure, absolutely.
Okay, so this is a risk question. Do you believe in spread between junk bonds and investment grade bonds is sufficient to compensate for the increased risk? And that's asked by Jack.
Hi, Jack. Yeah, that's a great question. And I think that as of right now, so looking at the economic growth, looking at the policies that we're going to get from the Fed, very importantly, looking at this chart right here in front of us, which looks at the maturity wall. I think that while spreads are still tight, you make a good point about IG versus high yield, and obviously high yield has tightened so significantly. But I still think that given the expectation of low defaults, I think you're still probably okay clipping coupon in high yield. But I would warn you of being broadly allocated to the index. And I would probably say that this is where you're supposed to be a little bit more discerning about where you go in high yields, and perhaps choosing quality, again, going for some of the higher quality names, companies that have termed out their debt, sectors that do have fewer maturity walls coming up. I think that makes a little bit more sense. But for now, I recognize the essence of this question being around the tightness of spreads. Yes, high yield spreads are very tight, but they can remain so. I don't know that they're necessarily going to go meaningfully tighter than here, but they can stay at these levels, which means that if you are invested in high yield, you can clip that coupon and earn very good carry in your portfolio for the remainder of this year, for sure, perhaps even for a part of next year, because again, growth remains solid. The Fed's poised to cut rates, but more importantly, the fundamentals remain solid, right? So default rates remain low because maturity walls have been termed out. So bonds are not coming due to mature. And if they're not coming due to mature, they're not necessarily, they're not necessarily going to have an opportunity to default. And, with private markets picking up, a lot of lending in the bank loan space has gone into private credit markets. So I think we're a lot more, it's a different high yield market today. The double B market is a lot higher rated and a higher quality than it used to be in the past. So I think while spreads are tight, you're supposed to be a little bit more discerning, but it certainly makes sense to remain invested.
Fantastic. Gargi, this has been an amazing hour. I so appreciate it, as well as I know our clients do as well. Thank you.
Absolutely. Thank you for having me.
And thanks to all of you for joining us today. We know your time is valuable. Make sure you let us know your thoughts on the webinar in the Q&A tool. As a reminder, we have a number of great other webinars like this one coming up, and you can find them at www.fidelity.com/webinar. We look forward to seeing you in future webinars. Until then, stay safe.